Hello, everybody. Welcome to the Conscious Capital panel on building wealth and investing ethically. I'm Isabel, a Sustainability Management Master's student and board member with Women and Sustainability, and I'm honored to be joined by three fantastic women who are leading the way across the spectrum of ethical investing. Many of us in this room are pursuing purpose-driven careers because we're passionate about making a positive impact in the world. But at the same time, we are ambitious, high-achieving young professionals who want to build careers that we can be proud of and that support the lifestyles that we envision for ourselves. So I'm particularly excited about this panel because I think that women don't talk about money enough. And I think we have to know that we can start investing, growing our wealth, and managing our own finances while still staying true to our values. So my hope for today's conversation is that you'll walk away feeling empowered and confident in making financial decisions, regardless of where you are in your investing journey. Sarah, Cameron, and Joan, thank you for joining me. Sarah is head of sustainable investing at JP Morgan Wealth Management, and she leads efforts to embed sustainability in client portfolios and advance JP Morgan's sustainable investing offerings. With nearly 15 years of experience, including at the values-based fintech, OpenInvest, which was later acquired by JP Morgan, Sarah combines deep expertise in wealth management with a commitment to aligning financial growth with social impact. She brings a traditional financial institutions perspective to this conversation, focusing on making sustainable investing accessible to a broad client base. Cameron is a private wealth advisor at Ellevest, a platform created by women for women, with a mission to close the gender wealth gap by empowering women to invest intentionally. She advises individuals, families, and nonprofits in sustainable investing and wealth building, all tailored to women's financial needs. With experience at JP Morgan and across private equity, Cameron brings an inclusive perspective on wealth management, emphasizing financial literacy and ethical investing to make wealth building more accessible. And Joan is a managing partner, investment committee member, and chair of the Sustainability and Impact Committee at TriLinc Global, a private credit impact fund that pursues both market rate returns and positive social and environmental impact, primarily in developing economies. With a career spanning international wealth management services, nonprofit development, microfinance, and mid-market investment, Joan leverages the capital markets to accelerate sustainable development and community empowerment globally. Her expertise will bring the global, impact-focused perspective to the panel, demonstrating finance's potential as a force for sustainable growth. Okay. As a reminder, we are going to have some time at the end of the panel for questions. But without further ado, my first question is going to be for all of you. As was clearly evident in the bios that I just read, you've all built very beautiful professional careers within the sustainable finance field, and I'm very excited to ask you about that in a moment. But I would like to start the conversation on a more personal note and ask you all about your personal investment strategies. How do your own values influence your approaches to managing your own finances?
I'm happy to start. Can you all hear me? You can? Okay, perfect. Thank you for having us here today. I'm Cameron Rogers. I'm at Ellevest. How do personal values impact finance decisions? One stat that is very striking for me, and perhaps this group has heard it because it's a very savvy group, is that we make 35,000 individual decisions every day. 35,000. There are some more consequential ones. You chose to be here today. You chose to be in this program. Inconsequential ones. You chose to sit in the seat you're sitting in. You're choosing to listen to me or not listen to me. Not many people are laughing, so I assume you're not listening to me right now, which is totally fine. That's a fine choice as well. But we make a number of decisions, and every decision is a vote, whether we like it or not. When we take that, rubric and apply it to money and financial capital, it's not only a vote, but there's a velocity to it. There's this velocity mechanism because you are moving money from your person to another person or company that is filled with individuals making 35,000 decisions a day and decisions with your money. So when I think about money decisions, I think of that velocity of capital, and that when money goes out the door, at least for me, and that could be on the consumption side or the investing side, I am now moving money into someone else's decision tree. So when I'm thinking about my own investing, I'm really thinking about that end partner and that end partner's ability to source investments that are aligned with me. So, full disclosure, I work at Ellevest. I'm also a client of Ellevest. I'm invested with Ellevest. I should probably disclose I'm also invested with TriLinc. This is totally random and wonderful, but that's, as you all know, the world of impact. So I'm anchored with Ellevest. And then, I also invest in the innovation economy and the venture space through venture fund partners that I know, and then in a few different, individual seed stage investment opportunities with primarily women owner-operators of companies that I know and are friends. So on the investment side, I'm hoping I'm about as aligned as it gets. I don't invest in anything that I don't understand. It just doesn't work for me. I would think the one area where I probably, dip my toes in the water was the digital asset space, but I really tried to marry the professional money management with the personal money management, because I think it's credibility, it's impact, it's all of those things.
Can you hear me? Okay, great. So I have to get the disclosure out of the way in the beginning. Sorry for this, but everything that I say is representative of my own personal views and do not represent the views of JP Morgan. Whew. All right, now we got that out of the way. So when it comes to aligning investments with my personal values, I think my advice to you all is think about, what do I actually mean when I think about values, right? What's actually important to me, and what do I actually want to see when it's manifested in my investments? So what's going to make me feel good about being in there if I look under the hood and see what the positions are, but also what's going to make me feel bad, right? What are the areas that I want to avoid? There's probably some sticky areas if you hold some personal values here and you're in this program. I assume that there are certain areas that you probably want to avoid. And so I think it's important to establish, first of all, those values. What do you care about, right? And then it's having that conversation with an advisor or with a fellow classmate or your parents or whatever it is, and coming up with the ideas of how do I actually now implement those values into my investments. So I think it's really important to, 1, establish the values, 2, establish the goals, and then 3, have that conversation to actually deliver and execute on those values. And how I manifest that personally is I also eat my own cooking. I work with a Chase wealth management advisor, and I brought up to him day one, this is important, this is my job, and so I obviously want this incorporated into my investments. How would you recommend that I do that? So I think it's really important to also bring that up if you are working with someone like an advisor, because they may forget to bring it up, or they may not know that that's something you're interested in. So it's very important to be proactive in that conversation as well.
Good morning, everyone, and thank you for being with us today. Following on my esteemed panelists, fellows, we are all trying to sort this out, right, and figure out how can we truly align our values with our capital. In my personal case, and I'm just going to sound like an echo here, but TriLinc Global is a privately held firm. So I have both equity in my firm and also promissory notes. So you think about how you invest. You think about investing in cash, in equities, in fixed income, maybe in real assets, maybe in alternatives. And if any of those aren't familiar to you, that's okay. You'll learn about them going forward. But I try to think not only about my values, but also across my asset classes, because that's going to help me figure out, what do I need liquid because I have to pay a student loan? What do I need to have set aside for my retirement, which is the absolute opposite end of the spectrum, which is a long-term investment, and they're not going to look the same. So I encourage you, first and foremost, to think about what you own, what you owe, what your values are, what you're afraid of, and where you think you can make a difference. And I'm going to say making a difference is not only about money, even though that's about our panel, thanks to Isabel and the wonderful team of Uplift. We are thinking also about not only our treasure, but our time and our talent. So think about all of your resources and how you can best deploy them. In my personal case, in addition to investing in my company in both debt and equity, I invest in ESG ETFs. It's really easy. You can just look them up online. They're cheap to hold. There's a ton of them. Your eyes will glaze over looking at your screen. But you will find ones that are important to you that resonate with your values. I also invest in some social bond type investments. And I'm always looking for market rate. I want something that is not going to force me to choose between my values and my future wealth. So always think about where your pain point is around really wanting to make a change in the world versus needing to pay that student loan or buy that apartment. So, and then ultimately where you can really get the rubber to hit the road is through direct investments. We've heard venture capital mentioned, private equity, private debt. You need to tend to have a little bit more money to do that, but there are a lot of exchange-traded products out there that you can have daily liquidity. You might need $25,000 minimum dollar investment, but you can get into funds that will have a direct investment into a company, so you have more influence on them instead of owning a stock that's got a $1 billion value in the market and your $100 investment isn't really going to move the needle. There are ways that you can get more direct influence. And in my case, I've been a private equity investor in 2 socially oriented initiatives that are dear to my heart. So before we go on, if I can just ask a question with a show of hands, how many women here feel like they are absolutely comfortable thinking about how they're going to manage their money and their investments? Okay, we got a few. This is good. But what I really want to do is put the fear or the sense of shame to rest. Here's the fact. Up until 1974, women in our country, you may know this, were not allowed to have a loan, get a mortgage, or get even a bank account by themselves. They had to have a male cosigner, and that cosigner could even be their son, or their father, or their husband, or their brother. So think about this. You're of the age that your grandmothers probably could not even own a bank account. So your mom did not see her mom managing money. How many of you have a memory of your mom managing the family finances? Good, this is great. Think about that, think about what you learned, and there are some exercises that if we have time I'd love to do around those, like digging into that and our ingrained beliefs and fears about money. But don't be embarrassed, because this is the landscape, and this is the landscape that we're changing. So I'm just gonna finish on a note that as of today, women in our country own $10 trillion of assets. So yes, women power, right? By 2030, it's estimated that we will own $30 trillion because we are working and we're living longer, and we're going to inherit, because our dear beloved partners, if they're male, tend to leave the world before us. And we will inherit that money before the next generation. So just hold on to that thought. We're going to get back to this idea and dive in a little bit deeper. But we have power, we have the skills, we have the information, and we have the peers and the team of friends, family, advisors, the internet to help us figure this out, and we're going to succeed.
Thank you all. Thank you, Joan.
There, just drop the mic.
Yeah, mic drop. My next question was going to be on what advice you would give to somebody who's just starting on their investment journey. Like, what are the first steps? But I feel like you all started to talk about that. So you teed up my follow-up, which will be kind of building up on the advice that you all just started to give. Young professionals, especially women and or underrepresented groups, can feel daunted by investing. Investing can feel daunting. So what advice would you have for breaking down those barriers to wealth building? How can we make investing more inclusive? And that's open for all.
Oh, there's so many things. I think, so the good and the bad are the same, and that is that all of our money decisions are interconnected. So the great thing is that they're all interconnected. The tough thing is that they're all interconnected. So it's like, well, where am I supposed to enter to like sort of get into this wheel of money creation and money management? If you haven't done these already, and this is more the basics, it's a little less related to the impact space, but there are always two things I recommend to just better understand where you are, because if you don't know where you are and if you don't know what you have the capacity to invest, like how do you even start investing? So how many individuals this year filed a tax return? Yeah, a lot, fantastic. How many people actually looked at that tax return? Oh, nice. Okay. So for those who review their tax return, and I'm going to call on someone in the group, like who enjoyed it and what did you learn? Yeah, let's go. I love it. Okay, so just to repeat for the group and anyone else listening, I don't know if they're online, if there are people in the ether, but enjoyed reviewing a tax return to one, understand what you earn in any given year, and two, how you're utilizing deductions and if there can be more that are utilized in terms of deductions. So that's a big piece because you may have a full-time job, W-2, you may have a side hustle, you may be contributing to your 401k. Like all of these things are important to understand to really get to know what you're working with. So for anyone who hasn't done it, that's like step one. Always enjoyed with a glass of wine or ice cream or whatever else makes you feel good, because taxes are not fun, but they are always present, pretty much always present. So that's kind of like the what you are earning. Yeah, question. Yeah, it's a great question. So the question was around a discrepancy between the government's sort of understanding of your tax liability or asset and TurboTax. Like I find a lot of those tax services are most helpful for thinking about line by line. And because the government sort of processing piece is relatively new, I would imagine that the discrepancy may have been that it's kind of like a pretty early service, but great question. On the other side of the ledger, I always say it's really good to think about the spending side of the equation. I want to caveat that one thing I think Ellevest are always frustrated with is that money advice focused on women is always on the spending side of the equation. It's always on the expense management that cut this out, really sort of creating like barriers around one's money as opposed to being very expansionary. So I'm talking about spending, but I don't want everyone to be solely thinking about spending, but it's an important thing. For my own, and I talk about spending to go back to this idea of our 35,000 decisions we make every day. So I use a spending management app called Rocket Money. I like it. There are a lot out there. Use whatever resonates most for you. But I really like that it categorizes all of your spending. You have to sync it with your credit card and debit card and whatnot, and then shows you, your highest and most consistent spend every month. I live here in New York. I've been here for 10 plus years. I very much feel like a New Yorker, and I take great pride on walking or taking the subway every day. And if we think about sort of like New Yorker value system, that is my value system. Guess what is my highest and most consistent spend? Uber. Every month? Uber. So we could be like holding ourselves to these high ideals and touting all of these things, and where we're spending money could be in complete conflict with that. And that is my complete conflict, and yes, I am working on it, and yes, I took the one up here today, so thank you very much. But I would really start with those two sides of the equation. Again, that's not even the investing side of the equation, but you want to know what you're working with, you want to know what you could be working with, and that's really that expense side. And then you can say, okay, here's this sort of pool of money, and I can kind of begin to think about the management of that.
So I'll pivot over to the investment side, and my advice is short and sweet. Start small and start early. Do it now. If you haven't started investing now, get on it, like go on an app right now, go right after this panel, set up an account. You gotta start now, because you probably all know about compound interest and the idea of compounding, but your money grows exponentially over time. And the earlier you start, the better it is for your wallet and your savings and your retirement down the line. So you gotta start if you haven't done it already. The easiest path, I would say, is to do something that is kind of like set it and forget it. Right? So if it's a 401k, you just do a portion of your paycheck, or you can do something. I'm disclosing my boyfriend's secrets, but he actually will have a piece of his paycheck go directly into a separate account that he set up that is reserved for a specific expense. We want to get a dog next year, so he has a puppy account. And so if you want to do something like that, it's automated, and then he doesn't even know that it's coming out of his paycheck, and he doesn't touch it. So anyway, like that works for him. If that works for you, you should do it. But I just recommend that you figure out what works for you to be able to set up a regular amount. Doesn't have to be big, but start small and just do it as soon as you can, because those savings are just going to grow every day as you start to invest. So that's my short and pithy advice.
I couldn't agree more, and I think just diving a little bit deeper into some of these thoughts, we need to make investing more inclusive, but for ourselves, we need to save in order to have money to invest. So the savings component, it's kind of the flip side of what Cameron was saying. We have to think about how can we save money. And so there were some ideas like take the subway. I would encourage everyone to have one credit card. You don't need multiple credit cards, because that just gives you more opportunity to spend more money. And that way you also control, exactly what you spent. A lot of us have our credit cards on our iPhones now, so this doesn't work so well, but when I was your age and up until recently, I had a little slip of paper stuck in the sleeve of my wallet right in front of my credit card that said, "It's not a bargain if you don't need it." And it made me think about everything I was gonna buy, right? So give yourself help. Give yourself little tips like that. Certainly, taking the subway, not only does it save your wallet, but it's also green, right? If we care about our environment, let's use mass transit. So think in your own mind, and this all comes with creating a budget. I mentioned that earlier. You really want to understand what you have, what you owe, and what your future goals are, like getting a puppy, taking that vacation, buying an apartment, and start saving. The idea of compound interest, if you put aside $100 and did nothing else to it, in 10 years it would be $155. You just earned 50% without even doing anything. The idea of saving early. This study's a little bit old, but they did a study of people who started to save only 10 years from age 25 to 35 and never saved another penny, compared to someone who started saving at 40 through 65, so not 10 years of savings, but 25 years of savings. Who won the savings race? The 10-year investor who started young. So these are really compelling reasons as to why it makes sense to start saving and to start investing. Now, how we democratize investing is another question, and we can do better. I was talking before, and we've all mentioned, yeah, we invest in some private equity or some venture capital. That's not accessible to the man and woman on the street. And in fact, this was a reason why in TriLinc we launched in our very first fund. It was a retail fund. The minimum investment size was $2,000, and the suitability standard of income was $70,000. So within the realm of having to be an accredited investor having $1 million or being a qualified purchaser having $5 million, this was a pretty accessible investment option. And so you can invest in things like, look at community development finance institutions. They're called CDFIs or community banks. These are good banks in the sense that they invest back into the community. So they're giving loans to small businessmen and women in that community. They're giving loans for mortgages. They're giving college loans. So this is a really great way. They tend to pay a little bit more than your traditional bank. Now, you want to read the fine print, but you want to make sure that they will be FDIC insured. You want to look at their history, and I'm going to give you a tip, an easy way to find out if they're good or not without having to give yourself brain damage looking at financial and balance sheets. There's a group out there called C-Note. They're based in San Francisco, and they take investors' money and basically corporate money. So they're taking like Apple and PayPal and Venmo money, and it's on their company balance sheets, and they want to do good with that money. So they give it to C-Note. C-Note goes around and looks at all these CDFIs around the country and picks ones that have a certain tenor, so how long you want to make your investment. It could be 90 days, it could be a year, it could be 5 years, and what the interest rate is. You're going to have a target in your head. On their website, they list who their CDFI investor partners are, so you know that they've been vetted. So you can start with a shorter list and then look at them yourselves. So CDFIs, other types of banks that have community reinvestment programs, these ETFs that I mentioned, they're absolutely democratized because you can get in with $100. So there are ways to follow the advice and start saving young and just make a few decisions. I want to go back to how you think about your values, though. Some values that we have are investable and some are not going to be investable at this stage, or they're going to be investable but below market rate. So go back to that idea that you have a lot of resources and it's not just your money. So if you care about something that isn't investable, you can make a philanthropic contribution to an organization that is dedicated to that cause and get your tax break, or you can volunteer. So, think about your bigger picture, but on the financial side, there's a definite way to get into impact investments now without having to wait.
Thank you all. And on that note, Sarah, I'm hoping that you can talk to us about how, with your own clients, investors, how do you address the misconception out there, though maybe not exactly in this room, that investing ethically, responsibly, sustainably requires concessions on returns?
Yeah, I think Joan actually started to hit on this, right? There is the idea of concessionary investments. That does exist out there. But there's most of the sustainable investments that I actually cover in my day-to-day job are not concessionary. They are market rate. And so if you think about the sustainable investing market, I think I pulled up the Morningstar stats yesterday. It's over $3.5 trillion globally, sustainable investing assets. So there's a lot of money going into these types of strategies, and there's over 5,000 different products out there. So you have a lot of different options when it comes to sustainable investments and doing something that is aligned with your personal values without sacrificing returns, without losing your hard-earned money. That's not what we're here to talk about today necessarily. We're here to talk about the spectrum of investments, right? So if you think about your money, you can think about it as a spectrum in terms of what you hope to achieve financially from that money, right? And so you can start at philanthropy. You expect nothing in return. This is just something that you wish to donate to the charity of your choice out of the goodness of your heart, right? So no financial expectation, right? And then there is the idea of philanthropic capital, and so that can be concessionary at some points to access different investments across the world that may not have market rate investments available. But then there's a broad swath of investments here that are considered market rate, and in some cases can actually generate alpha for your portfolio, can generate money, excess returns outside of whatever the index is generating. So I think there's lots of different investments now. There's thousands of options, and so I think it is a myth to say today that sustainable investing does mean sacrificing your returns, because in the conversations that I have every day, I'm telling clients that no, that's not the case anymore, and we have lots of options that can meet your financial objectives. So I cover lots of different clients across not only the Chase channel. Chase is the branch that you can walk down the street and enter, or I also cover the JP Morgan Advisors channel, which is the First Republic and the Bear Stearns channel. And so there are ultra high net worth clients in there, as well as foundations and endowments. So I actually see it all. I cover the entire spectrum, from like someone who walks in the door and has like $100,000 to, the billionaires of the world. So at the end of the day, honestly, the sophistication of the client really depends on the client. I've met billionaires who know nothing, to be honest. And so it really just depends on whether or not that client was brought up with a financial background, and if they have had that conversation with their families, because there may be instances where, especially the children or even the grandchildren of a particular client may not have even known that their parents were well off or had money. And so they may not just know a lot about finances. So I think the answer is it depends.
And there are some, to add on, that was a great answer. There are some investment-specific criteria, so it may relate back to your individual or household income. It may relate back to your net worth. And if you're in the investing sphere, there are some ways to check those boxes based on your level of expertise in investing. But there are some sort of technicalities for often non-liquid investments, just to make sure that they're appropriate for individuals' timeline and focus and whatnot.
Can you speak a little louder?
Yes. What I'd love to hear is, of those that are more sophisticated investors, particularly what defines their expertise. Is it 4 years of experience? Is it something that they learned? Is there a particular process with which how they approach their investing? I think I really want to understand the best investors that you've seen, what sets them apart, and not the requirements to be an investor, but whether what they do or how they think, what makes them different from everyone else you see.
If I can take this, because we have 8,000 investors in our funds, and can you hear me? Yeah. Great. So it is true that sophistication does not have any correlation to the size of your bank account. What we see are people are learning about finance either because their parents took the time to sit them down and share, and not all parents will do that. I personally was lucky. I knew how much my dad made. I knew how we budgeted and what got set aside for what type of expense in our home. I knew what they were saving. I was lucky, right? But you can start to do that on your own, and there are investor circles that can help you. There's a group that is women, and they come together and they are talking about their money and how they invest, and they share tips, they share knowledge. That's how my mom learned how to invest, and she ultimately took over investing from my household. The next way to learn is by reading a lot, listening to podcasts. So pick certain themes, keywords, and find podcasts that you feel are supporting you. You tend to learn, if you go into finance, a lot just through your job. Like if you're in a marketing role, take the time and sit with the people who are on the investment team or who are, the treasurers or the internal controller accounting people in your company, and just learn what they're doing and how they're thinking about investing and money and that kind of thing for the firm, and that will also help you. And I think ultimately the drive to know that you can be self-reliant, you can work with a financial advisor, and that's another great way to learn. But it's always going to come down to you and your values and your timeline and your risk-return profile and all those things that you can work with a financial advisor or with a peer investor group to sort those out and to start figuring out a strategy, and that's how you're going to get smarter. Yeah.
I'm going to ask one more question, and then I'm going to let you ask your question. Tying these all to impact, again, Cameron, you've written before or spoken about how really all investments have an impact, whether they're explicit impact investments or not. So I'm hoping, or I'm asking if you could help us conceptualize how we bridge that gap between thinking about the impact that we have in our work as sustainability professionals and the impact that we have with the way that we manage and invest our money.
Yeah, great question. I think it goes back to that decision making. When we were talking about sustainable investing, I was just thinking about the term sustainable because I think the first association with it is, or at least for me, this group may be more evolved than me, is like green or climate or some sort of like circularity. And we forget that, a synonym for sustainable is viable. And it's just thinking about like how we continue on and how we're investing to continue on. If you want to take a purely risk management perspective to all of this, I think about this type of investing as risk management, like really understanding people and processes and procedures and products that may not pass muster and sort of trying to remove that from your investment portfolio. So I think everything has an impact. As Joan mentioned, before I was able to build up some financial capital working, I think my biggest frustration was that I didn't have financial capital, and that seemed to be the capital of the world, if not New York City. So if you're thinking about that, just think about your other capital, your human capital, your relational capital. Before I had any money, I was very thoughtful about introductions and connecting people. So that impact piece extends beyond the financial. And then on the financial side, really think back to that decision tree. And when you're handing out a dollar, again, whether it's consumption or investing, who the counterparty or set of counterparties are that you're handing that dollar to.
Thank you. On that note, I want to tie it back to how Joan first started out the conversation, and then I'll let Ariel ask her question and anybody else who has one in the audience. Wealth building, especially for women, can potentially feel at odds with personal values, if your values are to contribute to a more equitable and just world. And I kind of want to address those feelings again. Can you talk to us about how we can reframe ambition and financial success as a positive, as a force for change, both for ourselves and for society?
I love this question. Before I do that, I want to get back to the question about how to educate ourselves. When you start working, chances are your company is going to offer a 401k. That program is going to have a ton of information. Go to their website, read it, call up your customer service rep, ask questions. That's another great way. And then I'm just going to put in a plug. If you look at your 401k, you're going to be dismayed because they have very few impact investing or even ESG offerings. Advocate. Talk to your HR person and tell them that you want to align your vision and your values and your capital, and get them to do their homework and find good investments that they can put in your 401k plan. Okay, off my soapbox. How do we align values and our feeling? Women are interdependent. We look at next generations. Cameron was making a really good point that when she's having conversations in this week after elections with people of all political stripes, how do they feel about what's coming next? And almost all of them, Cameron was saying, are talking about it within the context of their children and their grandchildren. So we think long-term and we think interdependently. That is a superpower that we have. Do not give it up, because that's what's really going to drive change in our world. So I'm going to take my personal case. I studied abroad in high school and college in Honduras and Colombia when those countries were extremely dangerous, extremely precarious. They were failed nations. And so I thought at first I was going to go into international human rights and create equality and opportunity through my lawyering in human rights. Being in Colombia and watching the whole process really unravel, where when there's no rule of law, laws don't matter. What I was watching was all the paramilitaries, the narcos, they were the ones who were making all the money and really determining the direction of the country and many other countries that they were trading drugs with. So I realized that the way I could actually make the best impact was through finance. So expand your aperture and think about things like that. So for 10 years, I did international financial services, and I learned a lot. But what I also did was I created a financial base for myself because I got paid well, and I saved in my 401k and had that compounding. And I was able to buy my apartment. So then I knew, okay, now I can take a different tack. And for 10 years, I went into international nonprofit development in Latin America, where we were working with grassroots organizations, helping people build self-reliance, get themselves out of poverty, and stay out of poverty. So your career path is going to be have twists and turns, but always fly by your best lights. Be thinking about your values. Be thinking about how you want to affect the change you want to see in the world, and you will find your way, and you will not have to compromise your values in the process. I was talking about how women, we are increasingly owning assets. 79% of women believe that it is vital that their investments align with their values. This is a sea change. This is a tidal wave that is not going away no matter what administration is in office. So just take comfort in that and exercise your right.
Joan, I want to follow up to your story because it actually resonates a lot with my personal story, which is that I actually went to Columbia Business School and I graduated in 2015. And I came to Columbia Business School for their social enterprise program because I wanted to go into the nonprofit world. But what I realized in going from the for-profit to the nonprofit world was exactly the same realization that you had, which is I thought that I actually could affect more change through finance and through the for-profit world. And so I actually made the considered decision to switch back into for-profit in order to make a difference. So I just want to, re-emphasize Isabel's point, which is that you don't have to feel bad about making money, but also doing good at the same time. There are opportunities out there where you can do both.
And I'm just going to say one more thing, Cameron, excuse me. Impact investing is a great field to get into, right? So as I said, when I switched from banking into nonprofit, I had to do that because impact investing wasn't on the radar yet. I didn't have the option to stay within, the for-profit workforce and do the change I wanted to see to the scale I wanted to do it. But ultimately, when I was doing that work, we were investing in affordable housing, we were investing in low-cost schools, we were investing in affordable healthcare, microfinance through grants. But you can see how this is also investable. And so I was able to, again, make that pivot and go back into investing, but with a purpose. So you will make those pivots and find your way.
One last thing. Why do we feel bad about being, what was your word, being ambitious about making money?
And financially successful.
Why do we feel bad about being financially successful as women? Because we think or we understand that there's a trade-off. And in the United States, there unfortunately is. One quote I gravitate to, it's by Jessica Calarco, that says, other countries have social safety nets. The US has women. So it's ingrained in us that there is a trade-off. But I'll say this, who feels better about the trajectory of their health and healthcare decisions after last week? And there may be some, and that's fine, and that's totally fine. But I think the majority of the group would say no. Coming into that election, women, 50% of the population, probably 80% of healthcare decision makers, 5% of research and development dollars goes to women's health. Pull out oncology, that's probably 1% to 2%. So if we're not ambitious, if we're not making money, if we're not funding it, even before this moment in time, who is? And I think that's why it's really, really important, and we don't feel bad about it.
And I think that really goes back to the idea of redefining ambition. If your ambition is to make the world a better place, what better ambition is there out there, right? And again, you can do it in a way that doesn't sacrifice your financial potential.
Thank you all so much. We did run out of time, but I encourage you to reach out and ask your question anyway. Thank you for your attention. Thank you to my lovely panelists for taking the time to share. And I will now I will give everybody a 5-minute break, and then we will have our next panel on stage. Thank you all.